Drought conditions have severely restricted Panama Canal operations. Average daily transits were reduced by 32% from a baseline of 35.5 vessels. This fell to 24 vessels per day by November 2023. Maximum permissible draft for Neo-Panamax vessels decreased from 50.0 feet to 44.0 feet. This reduction impacts cargo capacity by up to 40%. The vessel queue peaked at over 180 ships in November 2023. This represents an 80% increase from the 2022 average of 100 vessels. Average waiting times exceeded 15 days. Shippers are rerouting vessels due to Panama Canal restrictions. The Suez Canal alternative increases average transit time by 17%, or 5 days. Voyage costs rise by 22%, or $400 per TEU. The Cape of Good Hope alternative extends transit times by 50%, or 15 days. Voyage costs elevate by 56%, or $1,000 per TEU, compared to restricted Panama Canal routes. These alternative routes increase CO2e emissions per TEU by up to 56%, or 0.10 tons. This is due to extended distances and increased fuel consumption. Panama Canal restrictions impact specific trade lanes and commodities. 18% of 14.5 million TEUs on the Asia to U.S. East Coast route have been rerouted. This contributes to average freight rate increases of $450 per TEU. For U.S. Gulf to Asia LNG shipments, 25% of 12.0 million tons have been rerouted. This results in an average cost increase of $1.80 per MMBTU. The overall global container trade experienced an average freight rate increase of $120 per TEU. 1.2% of total global container volume via the Panama Canal was rerouted. Global copper demand is projected to double from 25.0 MMT in 2020 to 50.0 MMT by 2040. This growth is driven by the energy transition. Demand from green energy sectors is forecast to increase by 667%. It rises from 3.0 MMT in 2020 to 23.0 MMT by 2040. This constitutes 46% of total demand. By 2030, green energy applications are expected to drive 13.0 MMT of demand. This represents a 34% share of the total 38.0 MMT projected demand. Global copper supply from existing mines is projected to decline by 35%. It falls from 20.0 MMT in 2020 to 13.0 MMT by 2040. This is due to depletion and declining ore grades. Total supply, even with committed and uncommitted projects, will reach only 25.0 MMT by 2030. This is significantly below projected demand. A structural deficit is projected to emerge, reaching 13.0 MMT by 2030. It expands to 26.0 MMT by 2040, assuming current project pipelines. Global copper mining capital expenditure peaked at $55 billion in 2012. It subsequently declined by 63.6% to a trough of $20 billion in 2016. Current capex estimates for 2023 are $40 billion. This represents a 27.3% reduction from the 2012 peak. This indicates persistent underinvestment. Projects in construction or expansion phases represent only 1.5 to 2.5 MMT per year of potential new capacity. Average development time is 3 to 5 years. This is insufficient to address the projected deficit. European industrial electricity prices peaked at €350 per MWh in Q3 2022. This represented a 233% increase from Q1 2021 levels. EU industrial natural gas prices reached €200 per MWh in Q3 2022. This was a 700% surge from €25 per MWh in Q1 2021. US prices remained below €30 per MWh. The average industrial electricity price differential between the EU and US expanded. It grew from €40 per MWh in Q1 2021 to over €270 per MWh at its peak in Q3 2022. EU manufacturing industrial production declined by 8.2%. This occurred from its peak in July 2021 to January 2024. Germany's manufacturing IPI, a key European industrial benchmark, contracted by 10.3%. This was over the same period. U.S. manufacturing industrial production increased by 3.4%. This demonstrates resilience compared to European trends. The divergence began post-2022. European Commission approved €251.0 billion in state aid for energy-intensive industries in 2022. This decreased to €181.4 billion in 2023. Germany accounted for the largest share of approved aid. It totaled €120.5 billion in 2022 and €85.2 billion in 2023. This represents 48% and 47% of the EU totals. The temporary crisis and transition framework enabled these measures. Its cumulative approval exceeded €430 billion by end 2023. This aims to mitigate energy cost impacts and support green transition. Global semiconductor capital expenditure is projected to reach $190.0 billion by 2025. This represents an 83.6% increase from $103.5 billion in 2019. This investment drives significant expansion. Total 300 mm wafer capacity is forecast to expand by 51.7%. It rises from 6.0 million wafers per month in 2019 to 9.1 million wafers per month by 2025. CapEx peaked at $181.7 billion in 2022. It then experienced an estimated 11.9% contraction to $160.0 billion in 2023. A recovery to $175.0 billion is projected for 2024. China leads planned fab investment with an estimated $180 billion allocated for projects between 2021 and 2025. This investment primarily targets mature technology nodes. North America, specifically the U.S., and Taiwan follow. They project investments of $150 billion and $120 billion, respectively. Their focus is on advanced logic and memory manufacturing. Europe and Japan are committing substantial capital. Estimated investments are $80 billion and $60 billion. These efforts aim to establish regional self-sufficiency and diversify supply chains. Private investment in space resource prospecting companies increased from $0.15 billion in 2018. It reached an estimated $1.50 billion in 2024. This represents a compound annual growth rate of 46.5%. The projected market size for space resources is forecast to reach $10.00 billion by 2030. This is up from $0.05 billion in 2018. This indicates a CAGR of 59.8%. This growth is driven by advancements in situ resource utilization technologies. Strategic governmental initiatives like NASA Artemis program prioritize lunar resource utilization. Water ice from lunar poles and near-Earth asteroids is projected to have the highest demand by 2035. It is estimated at 750 metric tons. This is primarily for in-space propellant and life support systems. Lunar regolith, comprising silicates and metals, is anticipated to meet a demand of 300 metric tons by 2035. This material is for in-situ construction and radiation shielding for lunar habitats. High-value platinum group metals from M-type asteroids are projected for a demand of 3 metric tons by 2035. These target specialized electronics and catalytic converters for terrestrial and extraterrestrial applications. Propellant depots in low Earth orbit and lunar orbit are projected to become operational between 2028 to 2032. They will enable in-space refueling and mission extension through water ice in situ resource utilization. Orbital manufacturing and assembly facilities are targeted for operational readiness between 2030 to 2035. These leverage robotic assembly and 3D printing to fabricate large structures and repair satellites in space. The Lunar Gateway, an orbital outpost, is expected to deploy its initial modules between 2026 to 2028. It will serve as a critical staging point for lunar surface access and deep space missions. Global fertilizer prices experience severe volatility. Urea prices peaked at $850 per metric ton in March 2022. This represented a 240% increase from January 2020 levels of $250 per metric ton. Muriate of potash, or MOP, saw the most significant relative surge. It reached $1,000 per metric ton in March 2022. This was a 355% increase from its January 2020 price of $220 per metric ton. Prices have retreated from their 2022 peaks. However, December 2023 levels for urea, DAP, and MOP remain significantly higher than pre-disruption prices. Urea is 58% higher, DAP 93% higher, and MOP 68% higher than in January 2020. The global fertilizer market exhibits high concentration among key producers. Russia accounted for 20% of global potash exports in 2021. It also supplied 15% of nitrogen, including urea and ammonia. Belarus held an 18% share of global potash exports in 2021. The combined Russia-Belarus share represents 38% of the global potash market. The top 3 exporters for each fertilizer type collectively control over 70% of global trade. This market structure increases vulnerability to regional disruptions and geopolitical tensions. Global fertilizer price index surged by 180% from January 2020 to its peak in March 2022. This preceded the FAO food price index peak by approximately 1 month. The FAO food price index reached a record high of 159.7 in March 2022. This reflected a 62.8% increase from its January 2020 level of 98.1. A strong positive correlation of approximately 0.85 exists between the two indices. Fertilizer price movements often lead food price changes by 1 to 2 months. This underscores the food security implications of sustained fertilizer price inflation. The United States maintains 100% net import reliance for rare earth elements, graphite, and manganese. These minerals are critical for defense and high-tech industries. Bauxite and alumina exhibit a 70% net import reliance. This impacts domestic aluminum production capabilities. Cobalt and lithium, essential for battery technologies, show 76% and 50% net import reliance. This highlights vulnerability in the energy transition supply chain. The U.S. National Defense Stockpile, or NDS, peaked at approximately $10.0 billion in 1980. This reflected Cold War strategic priorities. Post-Cold War, the NDS experienced a significant drawdown. It decreased to $0.9 billion by 2020. This was a reduction of over 90% from its 1980 peak. Recent policy shifts have led to a modest increase. The NDS value reached $1.1 billion in 2023. This indicates renewed emphasis on critical mineral security. Lithium carbonate prices surged from $7,000 per ton in January 2020. They peaked at $80,000 per ton in November 2022. This represents an increase of over 1,000%. This rapid price escalation was driven by increased demand for electric vehicle batteries. Supply chain constraints also contributed. Following the peak, prices experienced a sharp correction. They fell to $15,000 per ton by January 2024. This demonstrates extreme market sensitivity and volatility. Global data center electricity consumption is projected to increase by 300%. It rises from 460 TWh in 2022 to 1,400 TWh by 2030. AI-specific data center consumption drives this growth. It is estimated to grow from 20 TWh in 2022 to 900 TWh by 2030. This represents a 4,400% increase. By 2030, AI data centers are projected to account for 64.3% of total global data center electricity demand. This is a significant increase from 4.3% in 2022. The United States is projected to require an additional 60 GW of power capacity for AI data centers by 2030. This is equivalent to 40 large nuclear power plants. China's AI data center expansion is estimated to demand an incremental 80 GW by 2030. This necessitates the equivalent of 53 large nuclear power plants. The European Union faces a projected additional demand of 30 GW for AI data centers by 2030. This corresponds to 20 large nuclear power plants. These figures highlight the immense grid strain. Large-scale nuclear power generation incurs capital costs of $8 to $12 billion per GW. It requires 10 to 15 years for development. This faces significant regulatory and siting challenges. Renewable generation, such as utility-scale solar PV with storage, has lower capital costs. It ranges from $1.5 to $3 billion per GW. Lead times are shorter, at 3 to 5 years. Transmission infrastructure is critical. It costs $1 to $3 million per 100 miles. Lead times are 5 to 10 years, primarily due to permitting and right-of-way acquisition. This temporal mismatch challenges rapid grid adaptation.